good April morning, everybody. This is Paul Ruedi, and welcome to Paul Ruedi's On the Money radio show. I'm here flanked by two of my sons, my two older boys, Paul Ruedi, certified financial planner, professional Paul Ruedi. Paul, good morning, and welcome in from Texas.
Thank you for having me.
Welcome to this weather, huh? And certified financial planner, professional, and retirement income certified professional, David Ruedi. David, good morning.
Good morning. Thanks for having me on the show.
And again, both Paul and Dave work with me at Ruedi Wealth Management here in town. You can call in with your questions at 217-356-9397 or text us on the Castle Heating and Cooling text line 351-5357. You can also email your questions to talk@wdws.com. We also want to welcome those tuning in on Facebook Live. The last couple of shows, we actually had people watching live from Texas, Florida, and for some reason, Vietnam.
I have a buddy over there.
Oh, do you?
Yeah, he's pursuing a photography career.
That could not just have been random. So it's nice to have viewers all over listening. It's important to recognize that past performance is not an indication of future results. You should not make any investment decisions without first consulting your own financial advisor and conducting your own research and due diligence. Pretty good idea, actually. This show is really, we're just trying to be educational, or more than trying to give you just answers. We're trying to give you the questions to ask your financial advisors so that you can be better informed and more knowledgeable going into your retirement and investment planning issues. Well, guys, lots of clamoring about interest rates. Dr. Fred Gertz, by the way, is traveling today. He'll be back on our next show, so sorry to miss Dr. Fred here. So usually I talk about this stuff with Fred, so
I'll do my best Fred impression.
You're not smart enough yet.
Not a chance.
The yield on 10-year Treasury note hit almost 3% last week, so that's the highest level since 2014. So interest rates definitely are ticking up. We're going to talk a little bit more about that. We've seen a bounce in economic activity, that's for sure. We've also seen a bounce in inflation rates, which is, of course, why we've seen 4 or 5 interest rate increases over the last couple of years. And I just read an article. I might bring it up. I just pasted it just before I got in here. The Congressional Budget Office expects that last quarter was probably 3.3% GDP. So it looks like we're going to have record GDP at least for many, many years. They figure all throughout 2018. The 10-year Treasury note is kind of important, and the reason we talk about it every now and then is it sets the rates for a whole lot of range of business and consumer loans. More importantly, probably for a lot of people, home mortgages. But we might talk about this in a bit. But my most recent indicator said that the Case-Shiller housing price index was up 6% year over year in February, and it's averaged about 6% over the last, for 70 months in a row. House prices have increased at an average rate of 6% per year. So looks like, and reading that article this morning, it shows there's really no real slowdown in this. The real problem is the supply and demand kind of imbalance. There's just the supply is kind of low.
Yeah, I mean, all you have to do is visit Texas to see that, or Colorado, or any of the big booming states right now. I mean, there is just so much demand, and there is not enough supply.
And so I think that's when you start thinking, we've had inflation at 1.5% to 2% per year the last 70 months, when they said that house prices nationally have gone up 6% per year. So that shows that there's pretty strong, there's probably an imbalance. There's a lot of people suggesting I try not to watch as much TV as I used to. I don't think I'm actually succeeding at that. Even when I was in Captiva, Florida last week, every now and then I'd see a pundit worrying about higher interest rates. Of course, that's going to wreck the stock market and it's true. I mean, it's not true that it will wreck the stock market. We've had higher interest rates, and that is a higher discounting mechanism for future earnings. But when you look at inflation picking up and growth growing up or getting stronger, I really don't consider the Federal Reserve being too tight, and that's really what this gets down to: is the Federal Reserve being too tight? Is it going to take the punch bowl away from the party too early? And to me, I don't know how you guys feel, but until the Fed funds rate gets to about 3.5%, we're a ways from there right now. The 30-day Treasury bills, I think, is at 2.25%, which is quite a bit higher than it was, than compared to a year ago. Probably 1.25% higher than it was. But we've had basically nominal GDP of about 3.5%. Okay, so that's before inflation. So we've had real GDP growth of about 2%, and inflation growth about 1.5%. And to me, it's always, my observation has been, until the Federal Reserve kind of hikes the overnight lending rates above that nominal GDP rate, you're not really in a tightening mode. And I'm not even sure it's going to be at 3.5% because, again, earnings are expected to grow another 15 to 20% going forward over the next year. So combine that, I just don't. I'm not really. I think the Federal Reserve has to go above 3.5%. Even we're not even that close to there before it's tightening. So that really doesn't hold water to me as far as this higher interest rates having to lead to lower stock market. Like it's a given.
I think Dimensional Fund Advisors actually had an article on that because I was just reading about it because people do make that claim as if it's kind of like this direct correlation between interest rates and stock prices. And the takeaway was that there's just really not a strong relationship in general. And like you said, there is a case to be made for why higher interest rates could theoretically have a negative
If
impact.
everything stayed equal.
Exactly, but that's a huge caveat because not everything is going to stay equal. And so much goes into stock prices in any given day, month, or year that there is no one factor that you can say, if this happens, this is what's going to happen to the stock market.
I agree, but you hear this daily throughout the day that higher interest rates equals lower stock market, and I think it can cause people to make some mistakes. Ben Carlson, who David and I met a couple weeks ago from the Ritholtz Group, he just published an article and basically it's like you can quit worrying about higher interest rates causing lower stock prices. And he went back to December of 1962 and he showed all the starting yield and the ending yields on treasuries over whenever there was higher increase cycles, interest rate cycles. And basically almost all of them, the stock market is substantially higher, going into the future by double digits or more. Pretty handsome gains. So you really look at the track record, it doesn't hold water. So people shouldn't be trying to reacting at all. Of course, we should never react. We should always be acting on fear of higher interest rates. As I said, U.S. Economic growth kind of continues to gain strength, guys. The Federal Reserve just came out with their beige book and indicates that the U.S. remains on track for continued growth. The one thing they did highlight is the risk of global trade war being the big outlier. So to them, that's the one thing that might derail it a bit. So the overall outlook among business remained positive, though many of the people they surveyed were worried about the tariffs. Of course, that's mainly agriculture, some manufacturing, transportation. They said that there's some evidence that the tax cuts approved in December may have begun filtering through the business spending and investment cycle. It's been a significant jump in commercial and industrial lending, so that's pretty solid. That suggests that economic activity is starting to even heat up a little bit more, which now that circles back to that CBO most recent report that says, look, we're going to be in for pretty strong GDP, at least for 2018. Really the one frustration, and I have friends in town and friends out in other states that have manufacturing businesses. They talk about frustration with labor shortages, including a high-skilled job mainly, engineering, information technology, construction, transportation. Overall wage growth remained only modest. So it's still, if Dr. Fred was here, I'd say that, I think this seems to me like a Goldilocks scenario. It's not too hot, not too cold. There's always things to worry about out there. But it strikes me, I don't know about you guys, but it looks like 2018 is still on track. And that doesn't necessarily mean that stock prices are going to go up just because the CBO. So I don't want to send a counter.
Right, because there's already the expectation that it's going to be great, right?
Yeah, there is. These things are always baked into the cake, and it's, they're always discounted. The future, what's happened in the past with earnings, what's happened in the past with revenues, the market's already over that. They're really looking ahead the next 6 months, 12 months. And that's ultimately what drives near-term stock prices. So that's kind of a little background on continued message of Fed's continuing to raise interest rates. I don't see that as a significant problem, at least at this point. There's been a lot of articles and pundits arguing the market's overvalued. I have a hard time getting there with my work. Seems like this would be a pretty good environment for investors. Even people in CDs now, I'm hearing are earning somewhere around 2% on, so depending on how long you go out in maturities. When you look at 30-day or 90-day Treasury bills earning 2.25%, that might have been 0.5%, a year ago. So you can see that there's been significant improvement. Now, of course, we're going to have higher inflation probably too. So it's one of those things. Everybody's waiting for higher interest rates. People that borrow money don't like it, but people that have been saving for the last 10 years, people in CDs and savings accounts and bonds, they've really kind of lamented the fact that we've had this epic low interest rates, and now they're welcoming these higher interest rates. With higher interest rates come higher inflation expectations. So it really doesn't change the net after tax expected return, after inflation return, fixed income. But it sure feels better getting 2 or 3% in a CD than 2 or 0.3%. I have to believe that. Well, guys, the next thing I want to talk to is a blog that I recently wrote about the incredible wealth that the compound return to the stock market can create over time. Now, that's the deal. Of course, we always have to be fair and say we're going to be talking about a look-back period here. And so in no way are we trying to imply that the results of my article or, suggest that these things are baked in the cake. But I wrote the article called The 1,000% Club. And we'll explain a little bit about that title in a minute, but people can go read that blog at ruediwealth.com. And for those of you tuning in on Facebook Live, we'll put a link on the comments. I wrote the blog, guys, because short-term fluctuations in the stock market can easily cause people to lose perspective. I mean, one day you seem like you have a good long-term perspective. The next minute it's out the window. It's usually because something happens in the near term. So I always like to step back and zoom out to try to get my perspective on things. And that was really what I was trying to get to in this article. So the title gave away, but basically how large returns, we're talking about 1,000% increase in returns, and I call it the 1,000% Club. And that 1,000% return, it sounds like a lot, but anybody with a long-term historical perspective, or I might even say memory, on stock returns, 1,000 isn't 1,000%, which is a bunch, by the way. Certainly isn't an unheard of situation. We always get focused in the short term, and we obsess as investors. We obsess about something being down 5% or 10% or 15%, when over their lifetimes, basically what I've observed is most people will experience 1,000% rise, 100-fold increase in the stock market index over their lifetime. And so I was talking to the boys about this, and I think son Paul went and did a little bit of research. So my 3 boys and I and the son-in-law Ryan, and they were wondering, is this something that, I think they started personalizing it a little bit. Hey, I wonder if that sounds like a lot, Dad. Could that even be true? So Paul, you pulled the return numbers for this blog. So you took your life first. What's been your experience since you were born? Talk a little bit about your experience and how that fits into my blog and this 1,000% Club.
So I was born in February of 1989, so I am 29 years old. And if you look at the stock market performance over the period from February 1989 to March of 2018, that's the latest full month of data that we have.
Sure.
The total return over my lifetime, drum roll please, was over 1,000%. It was actually 1,572%. So even 50% more than your title implies.
Right.
And that really surprised me, because I would have been surprised by 1,000, quite frankly. But the fact that it's way more than that, it really surprised me.
So it wasn't even a 10-fold increase. It was basically a 15-fold increase.
Yep.
So the other thing I think is kind of cool about that time frame of, about 30 years is, that's about the amount of time that people work in their job, probably 30 to 40 years. So you start looking at that time frame, that's what you can expect if you're actually, that's the time you're actually investing. And that's the type of stuff you can expect over your lifetime. If you just start investing day one, you get your first job, your first paycheck, you start investing. You don't have to do a lot just to experience, like you said, really fantastic growth of wealth.
So you think about a 1,500% return, which is basically a 15. If it was worth $1, it's $15 today. Does that include dividends, or is that just the price?
Yeah, that's the S&P 500 with dividends.
Okay, so that's the compounded annual growth rate, ending dollar value if you had reinvested, and that's important to point out that. But start thinking about that increase. And if a person was in a working career, obviously, you weren't, because you've been in a working career for about 7 or 8 years. But that does measure, David, basically a 30-year time horizon is a pretty common accumulation period for retirement. And what about you, Dave? So what's been your experience? Relay your experience, because you're younger. Have you made the 1,000% Club?
Yeah, so I was born September 1990, so not honestly too much after Paul, but you'll see it's still been really big growth. My total return over my lifetime has been 1,358%. So not quite that 1,500+% that Paul got just by being born, a little less than 2 years after him. But that's still pretty incredible.
What's that roughly compound at on a compounded rate of return basis? Dividends reinvested.
Yep. It works out to be 10.2%.
And what was yours, Paul?
Mine was 10.14%, which is almost exactly the historical average. It's something like 10.12%. So I almost nailed it.
Yeah, which is interesting. As we look at the long-term return since the early 1900s, it's somewhere around 10% compounded annual growth rate for the Standard & Poor's 500 index. But when you dissect all the 30-year periods, just as an aside, guys, because this is the stuff I do for fun. This is how I enjoy myself. I looked at all of the 30-year periods for the S&P 500. And actually, the median return is about 11%. So this would be below the median return if you looked at every 30-year period. So this is not above average return. This is actually below what the typical return is over a 30-year period.
Yeah, I think that's an important point to make. And if you think about it not from a purely numerical side, but just the time period we lived through, we lived through the lost decade, 2000 to 2009, where the S&P 500 over 10 years went down 9.1% with dividends reinvested. And that made up a good third of our lives. So if you would have told someone that, hey, you're going to have 1/3 of your life, the stock market's going to go nowhere, but you're still over a 30-year period going to receive a 1,500% return, I feel like people would look at you like you were crazy.
I think so. And, keep in mind, you mentioned the lost decade, but that lost decade, sure, it was flat, but it encompassed the second and fourth largest bear markets since 1900 or so. So, in the last 100, plus years, that was really, I think it might be the worst 10-year period from a compounded negative annual rate of return. And still, it's pretty incredible that you would experience such returns. And what we look back in history, we find out that this isn't that unusual. I mean, that's really what it shows. Now, should somebody take away from that then just give me 30 years and you're going to earn 10% or 1,000+% return? Or is just we're talking about a historical perspective and zooming in?
It's just perspective. I would never go out and suggest that someone is going to receive this exact same return again. But once you really start looking at it over longer periods and you start chopping up 30-year periods and comparing them to, say, the 100-year period that we have data for, 30 years is really not usually that different from a historical average of 10%. But when you're building financial plans, you can't necessarily bank on anything, even being average. You have to assume there's a whole range of outcomes. We don't know where the stock market's going to go, and we have to anticipate everything. So you can't build a plan on performance.
Okay, and it's interesting because we keep talking about this, and a lot of people talk about the long-term compounded rate of the largest companies in the U.S. at 10% a year. And Dave, I think you're going to talk about the rule of 72. But, that type of period is really not – it's really defined by a lot of different experiences for people. But the one that I think surprises clients the most is when I tell them that the worst 30-year period, at least – in the last 100 years or so, was 8.47% a year compounded for the Standard & Poor's 500 index. And we really start thinking about that. But that was during 1929 through 1958. So you can earn 8.5% and have a horrible experience if you're on the retirement side of life and you're decumulating as opposed to accumulating assets. That is, you're spending from your assets. So these long-term compounded returns are interesting. But there also matters whether you're accumulating, what your ending lifetime result is, whether you're just putting money away for 30 years versus adding to it over a 30-year period and dollar cost averaging it over time, or you're spending from, that's what we call the sequence of returns risk. But it's pretty fascinating. Dave, that didn't surprise you, though, did it?
No, as far as these numbers, it's about what you expect when you start doing the math. And you mentioned the rule of 72, which is kind of this rule. It's basically saying, if you want to figure out just roughly how often you'd expect your money to double, and again, this is kind of on average, so it doesn't work out this clean in reality, but it's just kind of a good guideline. Like if you want to just say, okay, ballpark, if it's, and accept that this is a really broad ballpark, you can take basically the expected return of your portfolio and divide 72 by that number. So if you take a 10% return, you would expect your portfolio to double every 7.2 years.
On average.
On average. So if you look at basically Paul's lifetime, a 29-year period, you basically say, okay, well, it's doubled from, it's gone up 16 times, essentially.
Right.
It's doubled from 2, then to 4, then to 8, and then that last doubling is going from 8 to 16.
Right.
So that gets you to that basically 1,600% return. It's about what you'd expect, just using that rule of thumb. And again, it's not always going to work out as clean as it did during Paul's lifetime, but I think that is kind of, like I said, it's a good rule of thumb that's going to get you somewhere in the ballpark.
Well, what's fascinating to me is I've been doing this for 35 years, helping people, try to make the best out of the one life they get with the money they have. And we can sit here and talk about a 30-year period. Paul, yours was roughly 30 years. Dave, yours a little bit less. And we look at that compounded annual growth rate, which was really terrific. But I can tell you very few people I've met have actually earned that return during that period. In other words, it sounds easy, but it's not that easy. First of all, Paul, you talked about, for both of you, that lost decade where the Standard & Poor's 500 index, basically if you had $10,000 invested in it in the beginning of 2000, by the end of 2009, you had $9,000.
And that assumes you never panicked out along the way, which
Yeah,
is really
on
easy
the
to do.
front end, when the broad market went down 50%, and then in 2008, 2009, when it went down almost 60%. And of course, this is always the undoing of investors, is not, are the returns there to be earned? Typically, in most people's lives, the returns they will find have been better than they ever imagined. It's just that they didn't get the gold out of the mine. They panic so easily. And that's probably the one theme of our firm and our show is, look, these returns historically have been there. It's just that very few people earn the returns of their own investment because there's so many ways to get panicked out and to get surprised and to begin following gurus and to lose that faith, patience, and discipline that are required to earn those returns. And that sounds easy, maintaining that faith, patience, and discipline. But you guys can see that, how investors behave. Even so, we go early into this year in January, everybody's happy. By mid-January, 2 weeks later, everybody's mini panicking a little bit. Not our clients per se, because there was virtually no reaction, but just talk about investors in general. The articles you read, I know you guys read a lot like I do. You get a real sense that, gosh, as I said 3 or 4 shows ago, when we went above 24,000, everybody was ecstatic. When we went back to 24,000, everybody was, what's wrong? What's going on? Is it broken? So a lot of people just do not tend to stick to their investments. And would you guess the reason for that? We understand the emotional side, but isn't the fundamental reason, just kind of going ad lib here, if people had a plan that basically then dictated the portfolio and the allocation, which just become a slave to the plan, do you guys suspect that it's easier to stay with your investment policy, whether if it's attached to a plan as opposed to just out here floating, bobbing like a cork?
I think so, because if you can actually look at your plan and, in spite of recent investment performance, understand that you're still going to be able to do everything that you wanted to do in your financial life, I think that's going to make you more likely to stick with your investments, because you really see that the purpose for your money is still fulfilled.
And some of it, I think, gets down to your investment philosophy, too. Like, I think if you really internalize the philosophy that we have, which is, look, we can't time when to get in and out of the market, so we're basically left with just buy and hold investing. And that means you're going to go through some scary times, but that's better than getting out at the wrong time or, getting in at the wrong time, basically just jumping in and out at inopportune times. What a lot of people do, even if they don't panic out at the bottom, they start chasing performance, or they shift. It's not a wholesale in or out, but they say, oh, maybe I'll increase my equity allocation now because the market's been up a lot. And they don't rationalize it that way. They come up with rationale for why they're doing it that sounds good.
Right,
but
it's
really
emotional.
They're chasing performance.
Yeah, it's an emotional decision, but they backfill with logic.
Right.
And
or the other variation of this is picking different mutual funds. Oh, this fund has been doing well, and this fund in my portfolio hasn't been, so I'm going to sell out of this one, and I'm going to swap into this new fund that's done really well over the last 3, 4, 5 years. And those things are more subtle than just panicking completely out, but they can still be extremely destructive to your long-term return.
Yeah, almost any way you cut it, all the studies you read, the more we trade as investors, the more we look. I guess it always gets back to, you're either a planner or you're a prognosticator. You're either trying to predict things, or you're saying, look, we can't predict things, But what we can do is we can create a plan that can be as bulletproof as we can. It's a plan that's going to need adjustment from time to time, and we're there to make those adjustments. We know where they're going to be from. And so largely from that extent, it really comes down to your philosophy. Are you a planner or a prognosticator? And I've said this frequently. Every successful investor I've ever met was plan-focused, goal-focused, and plan-driven. And every failed investor, kind of the corollary to that, was market-focused and performance-driven. And those those are just two separate things. You're either one or you're the other. One of them succeeds. It's not a lock, but they have a chance. The people that basically are planning-driven, goal-focused, it's not a lock, but they have a chance. I don't think people that without a plan have much of a chance at all. I don't know how you guys feel about that.
You know, and that brings up something I was thinking about the other day. You know, you always say that words are powerful. I feel like if we called kind of active investing or forecast-based investing what it really is, I think people would be less inclined to actually take that approach to investing, because we always use the term like forecasts, and that sounds sophisticated, like I'm
Right.
doing this analysis and forecasting. But at the end of the day, what you're doing is guessing. And I think if we said, oh, I'm guessing that the market's going to do this, or I'm guessing that this fund's going to do this, I think people would kind of realize what they're doing with their money, and they're investing based on guesses. And sure, you feel like they're educated guesses, but at the end of the day, they're still guesses.
I remember one time about 20 years ago, this reminded me of a story. It's kind of a life story. You use the word guess. I was asked to sit in on a pension meeting for a faith-based organization. And their advisors that were managing the pension fund, they didn't know who I was. I was sitting there just taking notes and being quiet, which for me, you know, is almost impossible, the being quiet part. And and these guys represented a brokerage firm. And they kept using the word bet. Well, we were making a bet that this would happen, and then we bet on this stock, and then we bet on. And after the meeting, one of the nuns said, well, Paul, what did you think? I said, well, sister, that guy used the word bet 9 times. Now, I don't know how you feel about your constituents that you represent, these participants in this pension fund, but didn't that bother you a little bit? These people are betting with your money? They admitted it. They used the word bet 9 times, and I think that's when the light bulb went off. So you're right. Words are powerful. And really what these professional active managers are trying to do is they're making bets with your money. And all the data shows that it's really a fool's game. It's really a loser's game, and it's one best not to be played. And you guys kind of got immersed in that when you were with Dimensional Fund Advisors. Didn't they basically build their whole story? And I think now they're the 5th or 6th largest mutual fund company. But what was your biggest takeaway when you guys, you know, after working at Dimensional Fund Advisors, which is basically a group, it's a think tank, I call it, of really smart people, Nobel Prize winners. Wasn't that your biggest takeaway from Dimensional, is you kind of got immersed in, God, this is such a waste of time. Isn't it even irrelevant to try to outperform things?
Yeah, I think sometimes almost to like a more intense degree than the vast majority of people, to where I take things for granted sometimes, because people will ask questions and I'm like, no, it doesn't matter. Like in my mind, that's what I'm thinking. Like, look, this doesn't matter. Or we don't know. Like that's the first thing that pops up. Oh, I have no idea the answer.
Right.
Because usually people are asking, well, where do you think the market's going to go? Or, you know, it's always forecast stuff. And the first thing that pops into my mind is, oh, I have no idea. And it really doesn't matter that much over the next 30 years. Who cares what the market does the next year? You know?
Right. A lot of things are irrelevant, but you have to be careful when you're talking to clients to not be dismissive. I think that's
exactly.
what you're
That's
getting
what I'm saying.
You know, we're kind of rigid, especially Dave Paul. He's very rigid in his views on this. Sometimes it can be off-putting if we're not careful.
Right.
And we'll see something as completely irrelevant. And, you know me, I can be a little blunt and say it a little too quickly, probably. And so much so that we have to measure our words with clients and really try to soften that up a little bit and say, well, we're not sure that really matters, and here's why. And we're always trying to educate people, though I don't think you can ever educate people to good behavior. I think sometimes that just comes down to a great advisor that looks you square in the eye during those turning points where you're about to make maybe a big mistake, and they say, sometimes it's just because I said so. That's why you don't sell. And so I don't know. We're always trying to educate, but do you guys think people? people have been more educated over the last 35 years from what I can tell. We didn't have the internet when I got into this business. And I haven't seen it result in any better behavior.
I don't think so, and I think a lot of it is because people have such short-term memories, right? Because think about it, I graduated kind of in the shadows of the Great Recession. People were, even when I was graduating in 2011, still having trouble getting jobs. When I entered the financial industry, that was all anyone talked about. And I was convinced, like, this one's different. People are going to remember this one forever. They're going to be scared about it for decades. At this point, is anyone really sitting around talking about 2008? I mean,
No,
it's only
10
years later from a huge, the market got overcut in half. And no one really talks about it. At this point, everyone's kind of just thinking about how much further up the market can go.
In fact, it's in some ways it's gone the other extreme. I wouldn't call it an extreme yet. People that might have felt like panicking back then are some of the same ones that are saying, why do we own 40% in bonds? That seems like too much. Maybe we should own more in the stocks. That's what's implied in the stock market. And you're right, that recency bias is one of those characteristics that we carry as investors that is a little bit of our, well, maybe not a little bit. One time they said, well, what are the two things you think get in an investor's way as far as keep them from being successful, having a lifetime of investment success? And I said, well, there's investment behavior, and I don't know that there's another one, because to me that just seems to be the one. You guys are immersed in all the Nobel Prize stuff with the people at Dimensional, but it doesn't make better investors. It just, we try to be better advisors because of it. We try to use those tools and pass that knowledge and that perspective on. But I find that people left on their own have a difficult time.
Well, and just touching on your comment about how there's so much more information available today. Well, yeah, I completely agree. There's a lot more great information available. There's also a lot more terrible information available. And people don't know how to differentiate between the two. Like, both people will have, pedigrees from good schools or credentials or whatever, and they don't know that one person's basically kind of a crackpot, even though he went to a good school, and the other person is providing good advice. And again, then it's still kind of like, well, whose opinion do you listen to? And I think sometimes it's almost like the good information gets swamped by the bad information, and people are getting hit that much quicker and harder by like the financial media. Anytime the littlest thing happens that's bad in the economy or for a particular company, it's blasted out in the news. And, if you think 60, 70 years ago, it probably didn't,
well,
it wasn't
to your
as
broker.
prevalent.
When I started, or just before I started, you had to go to your broker to find out what stocks were doing that day if you wanted to know before that night. And it's just amazing how far we've come. But the one thing that has not changed that I can tell one bit is that it hasn't made investors better. It hasn't made them better investors. All the education, all the knowledge, all the publications, all the research, all the models has not. And I think this gets back to, I think I hit on this a little bit the last show, we're primal beasts, and we still move away from things that cause us pain, and we move towards things that cause us comfort. Investments that are doing well, the most recent block of time, are bringing us comfort, and those three things in our portfolio that may be perfectly normal behavior, but they're in a decline, are causing us pain, so we start swapping one for the other, usually at the wrong time. And so it's kind of this behavior issue. It was a good article. I enjoyed writing that article. I'm glad, Paul, you did the data behind it to help me test my theory that 1,000% club, that's not such a big deal. Sounds like it, but it's not. It's attainable.
And just to kind of wrap up on this, because we actually put out the numbers for all the advisors at Ruedi Wealth, and Ryan, who's a few years older than I am, is actually above 2,000% return, and I'm going to have to put a big past performance as no indicator of future results on everything we've said in the last hour. And then I called it the 1,000% club because, unfortunately, Daniel did not make it. He just hasn't been on this earth long enough. He's at about 940% return.
He's not in the club.
No. And we won't hold him, accountable for those returns. It's not his fault.
And again, the whole point of the article was it's a perspective article. It's step back a bit from the noise, turn off the TV, turn off the pundits, just give this time, faith, patience, and discipline, and probably most people are going to be all right. So just wanted to highlight that, and since I had so many children, I figure I might as well price them out. Right? Okay. Paul, you had a most recent article published Friday on Investopedia, inspired by the recent back and forth in the markets. We've had 2 corrections really since the beginning of the year. And some of the lessons you wrote about that you can learn from, we should always try to learn, right? From if we start finding ourselves paying too much attention to that volatility. I know you shared the article on Facebook, Twitter, LinkedIn. It's on our website, in the media page on our website, ruediwealth.com. And if you're on Facebook listening today or watching and listening, we're going to put a link on that. So let's start with your first lesson from stock market fluctuation. There is no reward without risk. That was your number one.
Yeah, absolutely. And I think sometimes little episodes like this of stock fluctuation can just be a healthy reminder that that's why stocks return higher than bonds. It's because they fluctuate. There's no return without risk. And the reason that stocks have those higher returns is because every now and then they get unpredictable. They bounce around like we've seen lately.
Is that a better word to use instead of risk, unpredictable?
I think so. I mean,
or maybe you might say, I'm not trying to grade your papers. You could grade mine. There is no reward without near-term uncertainty or near-term unpredictability.
Yeah, that would be, I would say, probably a more thorough way of saying it, because it's not volatility that people are scared of. People aren't scared of the market arbitrarily bouncing around, right? They're scared of the impact that has on their finances and the uncertainty that bouncing around causes.
And that's when clients say, what does this mean to me? What does this mean to me? What does this mean to me? And, of course, that always circles back to the financial plan. If we have this period of volatility, negative volatility, nobody cares if we have volatility going up, right? And you can always circle back to the plan. Look, we talked about this. Volatility is why we have these premium returns. This is just what we're after. We have to always circles back to the plan saying that this is part of the plan. This unpredictability in the near term is required because we need the returns from those investments to make your plan work out. And it gets back to, what does this mean to me? Because that's really the ultimate question. And then most of the time, if it's anything halfway normal, which is 90% of any volatility, if you've done your planning right, the answer is almost always, it doesn't mean anything. It hasn't changed your plan one bit. And then it's kind of a relief.
Well, I think
ahead.
Paul mentioned, sorry to interrupt, kind of at the tail end of that section is the other lesson from that, which is just inherent in the message is, look, if you're investing in something that has a lot of certainty or it has a guarantee, it's probably guaranteeing mediocrity or guaranteeing very low returns.
Like if you look at certificates of deposit, even when they were earning 5%, people dream about that. And, of course, in my lifetime, I've seen CDs that earned 16%, 17%. But even the dreamy 5% CD is going to come with a tax bill for most people of 1 or 1.5%, leaving you somewhere around 3.5%. And trendline inflation historically has been around 3%. So regardless of what the nominal interest rate is, because you have no unpredictability of your return or when and how your principal is going to get paid back, you can't expect any material return. The second one, Paul, I think might have been my number one after 9 years of a ever-increasing stock market, a very powerful bull market, one of the more powerful we've ever had, is the stock market does not go up all the time.
Yeah, and I kind of chuckled to myself as I wrote that. I can't believe I'm even writing this, but truth be told, it has been so long since we've had a major 2008 type decline that people seem to have forgotten that they actually happened. I graduated, like I said, into the shadows of the 2008 recession, so that kind of left an impact on me. But if you think about the investment careers that my peers have had, they maybe started investing around 2012. They've pretty much only known an uninterrupted bull market. That'd be kind of like going to the casino and just nailing the first slot you ever hit. You think they're ATM machines.
Happen, right?
Yeah, that's the worst.
All right, we're going to try Joe. Joe, thanks for listening. How can we help you?
Yes, just a quick question or view, I guess, just want to get your thoughts. I've seen a couple of charts in the past, and it was saying about the same thing as far as, on average, how much money...
Go ahead, Joe. You're breaking up a little bit. I was going to ask you to maybe call back, but try again. Go ahead.
Yeah. It's the chart I was referring to is how much money should you have or put in retirement at certain ages of your life, like 20s, 30s, 40s, and 50s. And the last one was like at 65 at retirement. They said you should have 10 to 12 times your last year's wages in,
All right.
in retirement. Do you agree?
Okay, we'll take that off the
I'm
air,
just gonna
Joe,
rephrase the
because
question.
and we'll kind of rephrase it. Hopefully, we're going to get it right. We got about every other part of your word, but I think we got the gist of it. And if not, call back, please.
So the question is, how much should I be saving at different age ranges, or how much should I have saved? He mentioned at age 65, people say you should have, I think, what did he say, 18 times your salary? Or
He mentioned 12.
12,
10 to
okay.
12.
I would have expected higher than that. So,
Yeah,
Right.
yeah,
same
12. I think you should be really wary of any one-size-fits-all benchmark. What you have to understand is that how much you need to save can only be decided by what your goals are. And that can only be determined by a financial plan. And then it's really just a matter of how much do I need to save to fund those goals. Now, if I wanted to give a blanket statement to my peers, I would say save as much as possible, as early as possible, to benefit from that compounding.
Those are your most powerful dollars, your early dollars.
And it'll save you from, if you save on the front end, you may not have to save as much in your 30s or 40s, and you get to enjoy that a little more. So if you get a head start, that could be hugely powerful.
Well, and I've gotten this question a lot lately from some retirement plan participants that we work with, and I always bring up the fact that, like as Paul mentioned, especially the stage before you have children is the time, if you can, to try to slam away as much money as you can, because it just gets a lot harder to save money in your 30s and 40s when you have children with just expenses that go along with that, and education expenses and everything. So I think Michael Kitces, he's a blogger in the financial industry. He wrote an article and he basically said most people's savings is not this linear 10 to 15% that you hear people throw around. It's, hey, usually they can save pretty good in their 20s before they have kids, if they, as long as they have a decent job. Once they have children, it gets really tough, especially unless your income really goes up. And then usually that time period, once the kids are out of the house and you're in your peak earning years, people can really save a lot and play a lot of catch up. And I think that is a really good way of looking at things, because it takes the pressure off of young parents feeling guilty that they're not able to save a lot, or just anyone who's not able to save a lot for whatever reason. The fact of the matter is, life is not this perfectly linear, controlled thing.
Yeah,
You're going to have ups and downs.
it's lumpy. Let's face it. That there's the there's the ideal answer, and then there's real life answer. Right. And I've been doing this obviously longer than you guys have. That's what I've seen. Most, like everything's lumpy. So getting back to Joe, if I'm circling in on retirement and I'm in my 50s, I want to know that by the time, if I'm going to retire in my early 60s, if I had to pick sort of a rule, which is probably a bad idea, I'd say you want, of the money that you're going to rely on from your investment portfolio, you're going to need 20 to 25 times that. So if you need, so whatever you need, you best multiply it by that. So in other words, you can spend 4 to 5% from your investments in a balanced portfolio. Okay, you should always talk to your advisor to make sure that, because this is sort of a one size fits all and one size never fits all. But in order to try to give at least some guidelines and fence it in a bit, figuring you can spend from 4% to 5% from your portfolio. Now, that includes costs and everything, so this is why we're with a broad brush.
Right.
But I would think you'd want at least 20 times your spending amount.
Right, and I think the key is how much you're going to need from your portfolio, because that can vary tremendously. I mean, if you're someone who has a huge pension, we probably have people from the University of Illinois listening to this who are in their traditional defined benefit plan. Chances are you don't need much of a retirement savings in terms of just investment assets. You're going to have a good pension income stream for the rest of your life. Or, lower income people actually need less in terms of investment assets relative to their income, because Social Security is going to replace more. So that's where, as Paul's first answer is really the best answer, is there isn't a one-size-fits-all. It depends on your goals. It depends on your financial circumstances, your income streams that you have coming in.
So in other words, articles like that maybe aren't really have much value at all.
You said it, not me.
Well, I'm just saying, I think, but can you see where people struggle out there? I'm not suggesting Joe's struggling. I'm just saying there's a lot of people like Joe that are wondering about that question, and you get all kinds of conflicting advice. You would think more like medicine, you would get consistent answers to a particular condition, and you can get radically different ideas from article writers, financial advisors, so-called financial advisors, experts. I think that's probably the troubling, and the only solution ultimately is you only get to live one life. You only get to live yours. You're the only one with your set of conditions, with your potential Social Security income streams, pension income streams, if you're fortunate enough to have that. And it can really vary because you could have somebody that's frugal and doesn't need a lot of money to spend from their portfolio, and the same person with the same size portfolio may not make it because they need to rely too much on that portfolio. So the best answer I can give is if you're going to be in a balanced portfolio of somewhere 50 to 60% ownership of the great companies of America and the world, some people call it the stock market, and the balanced and high quality fixed income, short-term fixed income, you can spend somewhere between 4 and 5% depending on the structure of the portfolio and the cost and all that thing. And so that becomes simple math. Just use the inverse of that percentage, and that'll tell you the multiple that you have to have. But it becomes very difficult for people, and you can I can't say it, but like I kid around saying it's like a barber telling you need a haircut. Anybody that doesn't have an excellent financial advisor, I'm not saying it's got to be us. We're certainly not the only ones out there, is really probably leaving a lot of stuff on the table. They're going to have much more emotional turmoil than they need, and they may make mistakes they don't need to make, which gets back to emotional turmoil. They may improve their return, but the one thing they'll have is at least they'll have a plan that's pointed somewhere, and it gives you that feedback loop of how am I doing, how am I doing, how am I doing, I'm going to get there. So my best advice is to find a really high-quality financial advisor and ride them for life. Your third one, Paul, so we'll move on. Stock investors must remain invested at all times. That runs counter to a lot of people on radio shows. I listen to other radio shows in other cities and whatnot, and it seems like the vast majority of them take a contrary approach and would challenge you on that. They think you need to know what's going to happen and you need to adjust your portfolio based on current conditions. You're saying essentially that's nonsensical.
Yeah, and I think Dave kind of beat that one up already because ultimately people who are doing that are making guesses. So anyone who says that you need to be out of the market at the right time or somehow limit your downside protection when the market's going down, they're in one form or another making some kind of a bet. And that's really difficult to do because you have to get out and then get back in. And the getting back in part is where it gets really problematic, right? Because if you look at the wild swings in the stock market we've had lately, it goes down 3% one day, but then it's up another 3%
right.
one day. If you miss out on that 3% up day, just put it in perspective of a 10% annualized return. You've missed out on 30% of that return in that one day because you missed out that giant explosive return. So I think the lesson is you really can't predict when to be in and out of the market. So during times of wild swings of volatility, especially is when you need to be committed to your investments and not moving in and out because you need to catch those rebound days. The way I think Ken French put it is, and this was in the height of like 2008, you've stuck around for the risk, stick around for the return.
It's easier said than done.
I know.
We're talking about son Paul, certified financial planner professional, Paul Ruedi's most recent article, just a couple of days fresh in Investopedia about the takeaways from market volatility. This was interesting. And now do you talk, because you guys are younger, is this one of the things you impress upon your friends, your number 4? Temporary declines help young investors. Now, they don't think it does. They think people in 401k plans, every time we have a perfectly normal bear market, 20, 30% decline, they think it pushes retirement further away. You see it differently than that.
Yeah, the way I see it, if you're accumulating stocks over your lifetime and your mission is to accumulate as much as possible, you really shouldn't be sad when those things that you want to buy go on a 30% off sale. Think about anything else. If you're buying T-shirts, if they go off sale for 30% off, you're happy about that. You buy more T-shirts. You don't back up. So my thing is, if you're going to have this long-term time horizon, if you know this money is going to be invested for 30 years, only temporary declines can only help you because it's just a heaven-sent temporary sale on the things that you wanted to buy anyways.
And that you need to buy,
yep.
Right? Whoever ends up with the most shares of stock mutual funds gets the best retirement, I always say. So really when we think about volatility, and I know there's another one on there, it almost seems like our message is countercultural. First of all, if you want to earn the premium returns that the great companies of America and the world have historically provided, it's come with premium fluctuation. Premium unpredictability in the near term. And our view is celebrate that unpredictability. It's a required ingredient to premium returns. Not that it's a lock you're going to get them. It's just historically speaking. And again, past performance is no indication of future results. We have to remember that. But that's certainly a takeaway from historical. And the other is, if you're not done buying yet, then that actual fluctuation that so many people fear every now and then, as you said, you get a sale, sent from God that's a 50% offer if you're lucky enough. And now you're accumulating twice as many shares of those stock mutual funds than you were 5 or 6 months ago. And if it's true what I say, and it is, whoever ends up with the most shares of stock mutual funds gets the best retirement, then those short-term temporary declines are nothing more than a heaven-sent gift to investors that are still accumulating.
Yeah, there's a huge opportunity there, and I want to specify, don't sit around and wait for a temporary decline to put your money in the market, but if you get one, if you're lucky enough to have that happen in the time of your life when you're contributing to your investment accounts, maybe increase the contribution to your 401k or something like that.
But that's countercultural, because when we look at the data and see what people do, they're more apt in a down period in the market, even young folks, to see that something's wrong, it's defective. I got to either stop putting money in, and if I don't do that, at a minimum, I got to sell my stock mutual funds while I can. And then you start thinking of how that's, there's fast ways to lose money, there's slow ways to lose money and fail. There's a super fast way to do it, and that is by reacting to what's going on currently and actually by doing something. And so it certainly is countercultural to that. Again, you can get to that. I think we're about ready to wrap up here, guys. Got about a minute. So you can look at that article on Investopedia. You can go to ruediwealth.com, and in the media link, it's on our LinkedIn, Facebook page. We appreciate anybody, even if it's one person, who knows, watching us on Facebook. We hope people are enjoying that. That was Paul's idea. Figure we're doing a show anyway.
Should we wave? I don't know.
We'll wave at everybody.
That was awkward. We don't know what to do with our hands. All right.
So anyway, we're going to be back in a couple weeks. Dr. Fred Gertz will be with us. Just remember, folks, it's faith, patience, and discipline. It's been a long time since we've had a significant correction in the stock market. Could happen anytime, who knows, but just be emotionally prepared, rebalance, and you'll be just fine. So this is Paul Ruedi for Paul Ruedi's On the Money program with David Ruedi and son Paul Ruedi as well. Thanks for listening.